Hello everyone, and welcome back to Virginia International University's MBA 610 Taxation of Business Entities course. Tonight we're going to talk about implicit taxes and clientels, tax arbitrage, and restrictions and frictions, and how all of these different concepts relate to taxation of business entities. You should recall from Chapter 1 our discussion about implicit versus explicit taxes. You should remember that implicit taxes arise because the before-tax investment returns available on tax-favored assets are less than those available on tax-disfavored assets. And so all we're saying with that is that if I invest in a security or investment or finance instrument that pays me a return that is not taxable, then versus investing in an instrument that pays me returns that are taxable, then the instrument that pays me non-taxable, or we call them tax-favored returns, right, I am still going to be paying some implicit tax on, because the amount that I would invest in that would likely be more as a result of the benefit of the tax-favored treatment of the return, versus explicit taxes, which I have to claim the return for, say it's interest or dividends. I have to claim those. If they're not tax-favored, I have to claim those in my income for that year and pay taxes on them. The payment of that tax represents the explicit taxes. An example here is we say that we have a reduced yield available on tax-exempt municipal bonds, which become tax-favored because I don't have to pay federal tax on that interest, versus the yield generated by corporate bonds, which I would have to pay tax on. And so then we want to remember too that the before tax rate of return on tax favored investments are less than those on tax disfavored assets, right? Because the investment takes into account that I'm not going to have to pay tax on the returns. So I'm going to get less, and as an investor I would require less than I would if I were going to have to pay taxes, which would effectively reduce my return. This entire situation results in implicit taxes, which is, again, it's a lower before tax rate of return on investments. And so we can conclude that given differences in the tax treatment, that is tax favored versus tax disfavored, if after tax returns are to be equalized, so whether I'm talking an after-tax return on a tax disfavored asset or an after-tax return on a tax-favored asset, then the before-tax rates of return across the assets have to differ. And this we covered back in Chapter 1, so if it's if there's anything about this that doesn't seem clear or is confusing, it would be a good idea to maybe go back and read Chapter 1 again also. So differing tax treatment, that is implicit versus explicit, then gives rise to tax clientels. And when we talk about tax clientels, we're really talking about the proper investment for the particular type of investment instrument that's either being sold or being bought, right? And so we look at the proper investor, or the clientele for lightly taxed assets will often be different set of investors than for more heavily taxed investments. So think back to the different investment alternatives that we talked about, the different vehicles, and where the tax treatment for contributions, the tax treatment for earnings, the tax treatment for distributions of those investment alternatives, and think about the varying types of tax clienteles that might be appropriate for each one of those investment vehicles. And that's really what we're talking about as far as tax clienteles go, because for each individual taxpayer's particular circumstances, they're going to become a clientele for a particular security or investment that allows them to leverage those tax circumstances, all other things being equal. So to calculate implicit taxes, we need to provide a metrics against which to compare pre-tax returns. Implicit tax is defined as the difference between the before-tax rate of return on a fully taxable bond, which becomes our benchmark security, and the risk-adjusted before-tax rate of return on a fully taxable security. So if we think about a pre-tax return on a fully taxable bond is 10%, right? So before I pay tax on a taxable investment that I have, my return is 10%. The risk-adjusted return on a tax-exempt bond is 7%. Right? And the reason we say risk-adjusted return on tax-exempt bond is that we generally are assuming that our investment products are comparably have comparable risk portfolios, because if they don't, then we have to factor into the equation not only the tax considerations of it, but any kind of increased or decreased return as a result of the risk associated with the different investment instruments, and that's a little bit beyond the scope of what we're talking about here. So in this example, if I say I'm adjusting the risk on the tax-exempt bond, what I mean is I'm adjusting that risk to where it's the same level of risk that's on the fully taxable bond. So fully taxable bond, pre-tax rate of return is 10%. Risk-adjusted rate of return on a tax-exempt bond is 7%. So my implicit tax, right, the difference between the tax on the tax-favored asset or the tax-exempt bond and the tax-disfavored asset or the fully taxable bond, then my implicit tax on that is 3%. If we think about an implicit tax on a fully taxable bond is 0, right? And then the implicit tax on securities, we want to always keep in mind, who do we pay this implicit tax to? Well, we're really paying it to the issue of the security, because the price that we pay for that investment instrument has been adjusted to reflect the differential in the pre-tax rate of return. And so here we're just looking at some different types of investments, right? What are the different options to me if I'm looking at investing in something that has a tax-favored status? And so a full tax exemption would be something like a municipal bond, and we talked about that, right? So for municipal bonds that are in the U.S., we don't have to pay tax on, or we don't have to claim the interest earned as income. So that's an example of a tax-favored bond. Partially exempt or lower marginal tax rates, right? And so one example there would be capital assets, right? If I have a capital gain, earn a capital gain on the sale of some capital asset that I have, I'm taxed at a lower tax rate, and that's just according to the tax code. And so while I'm still paying tax on it, it's partially exempt, or in that I'm paying lower marginal taxes on it. Then we have this idea of tax credits. And good examples of this from history would be the targeted jobs credit or the energy investment credit, whereby there was, through the tax code, a way that if I went in and replaced my refrigerator and replaced my stove and replaced my microwave and my washer and dryer and my dishwasher with Energy Star or more energy efficient appliances, or if I replaced the storm windows and storm door on my house with storm windows or storm doors with certain energy ratings, I was able to claim a tax credit on my tax return. Now, those have since expired and aren't being offered right now, but some of these other ones, like the jobs credit and fuel credits, are still available. So tax deductions permitted at a faster than decline in economic value of the asset, and the perfect example of this is the depreciation, right? For book purposes, I record depreciation perhaps under the straight line method, or some multiple other methods are available to me according to generally accepted accounting principles or GAAP. But perhaps for tax purposes, I elect to use the MACRS or the modified accelerated cost recovery method, and under that method I'm able to claim a much higher depreciation expense for tax purposes, which results in a lower taxable income than financial statement income. Although, and we'll talk about this once we get through chapter 6, this idea of permanent versus temporary differences. But tax deductions, permitted at a faster than decline in economic value of an asset is an example of a tax-favored status. And then taxable income permitted to be recognized at a rate slower than the increase in the economic value of the asset's cash flow. And this is sometimes something that becomes available in the fuel and mining industry. where there are different treatments of revenue recognition for tax purposes versus financial statement purposes. So then the other side of the coin are tax disfavored assets. And so these are items like special tax assessments. And so one example of that are excise taxes, where they may. I think of examples like that would include gross receipts taxes, right? So that if I do business in a state where they may not have a state income tax, but they impose a gross receipts tax on all companies doing business there, where other states may not have a gross receipts tax, well, that's an example of a tax disfavored treatment, right? Taxable income recognized at a faster rate than income is earned, or tax deductions at a rate slower than the decline in the economic value. And so, again, these are the reverse side of what we were looking at if we were talking about tax favored treatments. And so here we just want to define this idea of clientels, right? And we said clientels were really the who the investor subset would be of all of the investors available for particular investment instruments. So when we think about that, we think about marginal investors, and those are taxpayers who are indifferent between purchasing two equally risky assets. And so those types of investors really don't care if they're paying explicit tax, or if they're paying implicit tax, or any combination of tax. Then we have inframarginal investors, and those are the taxpayers who are not indifferent to the choice of differently taxed securities, right? So I do care if I'm an inframarginal investor whether the return that's generating from a set of bonds I own is a taxable return or a non-taxable return. So tax clientels are those inframarginal investors, right? Those are the people, tax clientels, right? They are the subset of clientele that care about that difference with respect to taxes. And it is important that investors determine their proper tax clientels, because, right, if you're trying to sell investments, you want to make sure, or you're trying to encourage investment in your particular venture, you want to make sure that the audience that you're approaching is an audience that cares about whether or not that difference exists and what the impact of that difference is on their particular circumstance. And so we move now to this idea of tax arbitrage. And so tax arbitrage is just one example of the multiple different types of arbitrage that are available to investors. It just so happens that with tax arbitrage, we're using the process of arbitrage in order to eliminate our taxes. And the way we do that is by purchasing one asset that's a long asset. So we purchase that by definition if it's a long position, right? Then we're purchasing that with the idea that the value of that asset is going to increase. We offset that with the sale of another, what we call, or taking a short position, so the sale of another asset to create a sure profit despite a zero level of net investment. And so we can do that arbitrage process one of two ways, either through the organizational form arbitrage, which is constrained by restrictions in the tax code on deductible interest, and so it's a way of the IRS not allowing organizations to capitalize on arbitrage, but to a certain extent, and the same is true with clientele-based arbitrage. So let's talk about each one of those a little. So let's build on this idea of organizational form arbitrage a little. First, we need to assume that the same asset can be held in two differently taxed organizations and that the asset bears no implicit tax. And so once we put those assumptions behind us, let's walk through an example now where the taxpayer earns $100,000 per year in salary and they're in the 40% tax bracket, which under that scenario results in a $40,000 a year tax liability. let's further assume that the before-tax interest rate on a riskless fully taxable bond is 10%. So the taxpayer's tax liability can be reduced to zero if they borrow an amount equal to $100,000, right, which essentially becomes $1 million that they're borrowing with a 10%, we're told a 10% interest rate, right, and then investing this in a tax-exempt insurance policy that holds risk-free taxable bonds yielding 10%. And so the way this works is that the $100K in salary is used to pay the interest on the loan, thus the taxable income becomes zero, right? The salary minus the interest on the loan, because the interest is a deductible expense, takes the salary to zero. The savings portion of the insurance product, because we say that it earns 10%, and we invested $1 million, is now, it's earned its 10%, so at the end of the year it's worth $1.1 million, or $100,000 more than the $1 million loan amount. And then we would surrender the tax-exempt insurance policy, pay off the loan, leaving us with $100,000 after tax, which is equal to our before-tax salary, but we've eliminated our taxable income, so we eliminated our $40,000 tax liability, and we still end up with the $100,000. So this is an example of where the taxpayer, through the use of different organizational forms, that is, borrowing a salary on the one side, right, that was used to pay the interest on $1 million worth of debt on the other side, netted to zero. The $1 million at a 10% growth rate generated a 10% tax return. So it left, and when that was that generated a 10% return on the $1 million. That return was non-taxable, right, because it was invested in a insurance product that invested in municipal bonds, which get tax favored treatment, so that again at the end of the year this individual had zero tax liability but $100,000 worth of income. And so I hope that it's a very simple example, frankly, of how this idea of arbitrage works. So by we take a long position and at the same time sell at a short position, so that we essentially eliminate our tax liability. And so if we look at tax arbitrage by using a client-based arbitrage process, what we're really looking at is a strategy that is aimed at reducing the explicit taxes at the expense of increasing implicit taxes, or vice versa. And these strategies can arise when taxpayers take both long and short positions in differentially taxed assets, where at least one of these bears some implicit tax, and the taxpayers face different marginal tax rates. And so if we walk through an example of this, it's similar to our last example. So our taxpayer has $100,000 in salary at a 40% tax rate. So they have a $40,000 tax liability associated with that salary. We have taxable bonds that yield 10%, and the taxpayer has unlimited borrowing capacity at this same rate. And we assume that municipal bonds yield a 7% tax-free rate. So to eliminate the salary, right, or the tax on the salary, which would mean eliminating the salary, the taxpayer could borrow $1 million, which would at a 10% interest rate on the borrowing. They would have to borrow $1 million. That would generate an interest expense of $100,000, which would eliminate the salary, and thus the $40,000 tax rate, and they would invest the proceeds to earn $70,000 in municipal bonds, since we know that they yield 7% after tax. So here, via this clientele-based arbitrage, we've converted the salary income taxed at 40% into municipal bond interest income taxed implicitly at 30%. And so you can see we said client-based arbitrage, that's a perfect example of reducing explicit tax liabilities. That's the $40,000 that the client would have had to have paid on the $100,000 worth of income. But in taking this approach, they increased the implicit tax that they're paying. And they're paying that, again, as we said, they're paying that to the issuer of the bonds, right? but this is an example of client-based arbitrage. And so unchecked, we say that that clientele-based arbitrage enables high tax bracket taxpayers to convert income that would be taxed at high explicit tax rates into income taxed at lower implicit tax rates. When the IRS knows this, they recognize this happens. So there are certain restrictions put in the code to control this, and one of those is this idea of interest deduction limitations. So the IRS won't allow you to deduct more interest than what you're claiming as income, or the income that is exempt from being claimed. And so this is one of the many ways that the IRS has put constraints around this that limit the successfulness of it for a lot of taxpayers. And so we covered a lot out of Chapter 5. We talked about this idea of implicit versus explicit taxes again, which is a theme that runs through our text. We talked about this idea of clientels, and that clientels or taxpayers in different tax brackets become clientels for tax purposes for particular investment vehicles. And remember those investment vehicles that we talked about in a previous chapter. And then we talked about this idea of arbitrage, and how taxpayers can use either an organizational form or the clientele-based arbitrage process to manipulate and control this the implicit versus explicit taxes. But we also talked about these restrictions and frictions that are in the tax code and that are inherent to the transactions and to the economy and to the breadth of financial instruments available to taxpayers that curtail some of the ability to arbitrage. So I hope that this was helpful. Some of these are difficult concepts, and so I would encourage you to go back and read Chapter 5. Don't get caught up in a lot of the math and the formula. We'll get to that later, but do try to understand the concept and theory of some of these, because we build on to these later in the semester. And thanks for your time.